You may already know that you can use options to profit when the underlying stock index or ETF moves up or down. But did you know that you can also make money if the underlying trades in a narrow range? That's possible with a strategy called the Iron Condor. The motivation is to generate income through time decay and having all the options expire worthless. An Iron Condor is an option strategy that is the combination of two other popular strategies, the bear call spread and the bull put spread. A spread is an option trade that's made up of two or more different options that are executed at the same time. Spreads can be bought and sold just like individual options, and the term short simply indicates that you're selling the strategy. The Iron Condor uses options that share the same expiration date. It is typically created by simultaneously selling two out-of-the-money credit spreads, one being a put credit spread, where the strike prices are below the stock price, and the other being a call credit spread, where the strike prices are above the stock price. The concept is that if the stock closes between the strikes of the short call and the short put at expiration, the options will expire worthless, and you'll get to keep the full credit. The Iron Condor profit is limited to the net credit received. For example, let's say XYZ stock is at $63 and has been trading between $60 and $65, and an investor thinks it's going to continue to trade in that range. The investor trades the Iron Condor by simultaneously selling both the 65.70 call spread and the 60.55 put spread, all options expiring in 30 days. The call spread brings in a credit of 80 cents, and the put spread brings in a credit of 70 cents, for a net credit of $1.50, which equals $150 per Iron Condor. At expiration, if XYZ closes between $60 and $65, then all the options will expire worthless, and the investor will get to keep the net credit of $1.50. The maximum risk of this trade is $3.50. The difference between the strike prices of either credit spread is $5 less the credit received of $1.50. At expiration, if XYZ closes at $58, then all of the options expire worthless except the 60 strike put, which is $2 in the money. To avoid assignment, the entire trade may be closed out prior to expiration. Since the investor received a credit of $1.50 when the trade was initiated, the investor is left with an approximate loss of 50 cents. At expiration, if XYZ closes at $68, then all of the options expire worthless except the 65 strike call, which is $3 in the money. To avoid assignment, the entire trade may be closed out prior to expiration. Since the investor received a credit of $1.50 when the trade was initiated, the investor is left with an approximate loss of $1.50. The maximum value of these short spreads are determined by their width. So here, the most you'd have to pay to close either spread is about $5. Again, since the investor collected $1.50 when the Iron Condor was sold, the most the investor could lose is about $3.50, or $350 per Iron Condor. While Iron Condors are considered a high-probability strategy that profits when the underlying remains in a range, it's important to be aware of any major upcoming events, such as an earnings release that could cause the underlying to break out of that range. To learn more about the Iron Condor and other strategies, visit the OIC website at optionseducation.org.